The declaration that silver is never going back to prior price levels is presented not as a slogan, but as a conclusion drawn from recent events. The move above $100 an ounce is treated as a dividing line, separating one era of the silver market from another. In this framing, the significance lies less in the number itself and more in what that number represents about how silver is now valued and understood. The speaker reflects on how quickly assumptions that once felt permanent have been overturned. For long stretches of time, silver prices remained stagnant, reinforcing the belief that sharp moves were temporary and that mean reversion was inevitable. The current surge challenges that belief. The market behavior now unfolding does not resemble earlier cycles in either scale or structure. This opening establishes the idea of permanence without forecasting endless upside. The claim is not that silver will only move higher, but that the conditions which once kept prices suppressed are no longer intact. The market has crossed a threshold where old reference points no longer function as anchors. The tone remains reflective rather than triumphant. The speaker does not celebrate the price increase as a personal victory. Instead, he uses it as evidence that the underlying environment has changed. What once felt like a speculative outlier has become the prevailing condition. This section frames the documentary's central argument that silver's recent price action marks a structural shift. Whether prices rise or fall from here, the framework that allowed silver to trade at historically low levels for extended periods is presented as something that no longer exists. The speaker grounds this shift by looking backward rather than forward. He reflects on earlier periods when silver's physical nature was exactly the same as it is today, yet its market treatment was entirely different. Silver did not change as material. What changed was how it was priced, demanded, and absorbed by the global system. This contrast is central to his argument that the transformation is structural rather than superficial. In those earlier years, silver was widely available and largely overlooked. It was treated as abundant, slow-moving, and secondary. The speaker recalls stacking silver during a time when prices were low enough to encourage accumulation without urgency. There was little sense that supply constraints or strategic demand would meaningfully alter the landscape. The reflection emphasizes how market dynamics, not intrinsic properties, define value. Silver's conductivity, durability, and utility were always present. What was absent was sustained pressure on supply and consistent recognition of its strategic importance. As a result, price remained disconnected from utility for long stretches of time. By revisiting this contrast, the speaker highlights how misleading nostalgia can be. Remembering low prices without acknowledging the conditions that produced them creates false expectations. The past is not invoked as a model to be repeated, but as a baseline that no longer applies. This historical reflection serves to reset perspective. It suggests that longing for former price levels ignores the accumulation of changes that have already taken place. Silver's unchanged physical identity makes the transformation more striking, not less, because it isolates market structure as the source of change rather than the material itself. One example is used to make that transformation concrete. The speaker recalls purchasing a 100-ounce silver bar at a time when silver traded around $5 an ounce. The total cost was approximately $500, a price that reflected both market conditions and prevailing assumptions about silver's future. At the time, such a purchase did not feel exceptional. It was ordinary, repeatable, and unremarkable within the context of that market. That same bar is now valued at roughly $10,200. The increase is not framed as a windfall or a triumph of foresight. Instead, it is presented as evidence of how dramatically the valuation framework has shifted. The object itself has not changed in weight, purity, or function. What has changed is the environment in which it is priced. The speaker uses this comparison to challenge the idea that past prices represent a fair or natural equilibrium. The former price level is not treated as a norm to which the market should return. It is portrayed as a product of conditions that no longer exist. When silver traded at $5, it was not constrained by the same demand pressures or strategic considerations now shaping the market. This anecdote also highlights the distortion that occurs when long periods of stagnation anchor expectations. When prices remain low for years, they begin to feel permanent. The revaluation of the 100-ounce bar exposes that sense of permanence as an illusion created by stability rather than sustainability. By focusing on a single, tangible object, the speaker avoids abstraction. The comparison is simple and difficult to dismiss. It reinforces the idea that silver's current pricing is not an overreaction, but a recalibration driven by forces that accumulated quietly over time. Industrial demand is presented as a central force behind that recalibration. The speaker emphasizes that silver consumption for industrial purposes is now exceeding available supply. This imbalance is not described as temporary or cyclical, but as an ongoing condition that has altered how silver is absorbed by the market. Unlike investment demand, industrial use does not pause when prices rise. Silver required for manufacturing processes must be sourced regardless of market conditions. This creates a baseline level of demand that remains firm even during periods of volatility. As industrial applications expand, that baseline rises with them. The speaker highlights that this demand is structural rather than speculative. It is tied to production needs rather than market sentiment. Once silver becomes embedded in supply chains, it is continuously drawn out of circulation. This reduces the amount available for other purposes and tightens overall availability. The result is a persistent pressure that did not exist to the same degree in earlier periods. When silver was priced at much lower levels, industrial consumption did not exert the same pull on supply. The current environment is therefore described as fundamentally different in how quickly silver is removed from the market after being produced. This section reinforces the idea that price behavior follows usage patterns. As long as industrial demand continues to outpace supply, the speaker argues that the conditions necessary for prolonged low prices are absent. The market has been reshaped by necessity rather than enthusiasm. Strategic stockpiling is introduced as another force reshaping the silver market, distinct from both retail accumulation and industrial consumption. The speaker points to China and other nations, including Russia, as actively building reserves of physical silver. This behavior reflects a shift in how silver is regarded at the state level, moving from a commodity of convenience to an asset of strategic importance. When nations accumulate silver, the motivation is not short-term price appreciation. Strategic stockpiles are built with long time horizons and are rarely liquidated in response to market fluctuations. Once acquired, the metal is effectively removed from open circulation, reducing available supply in a way that is not easily reversed. The inclusion of multiple countries reinforces that this is not an isolated policy choice. It suggests a broader reassessment of silver's role in national planning. Unlike private investors, sovereign actors are less sensitive to volatility and more focused on securing access to resources they consider essential. This behavior contrasts sharply with earlier periods when silver was treated as plentiful and non-strategic. The speaker implies that the presence of sustained state-level buying alters the balance of the market. Supply that once flowed freely is now being absorbed into reserves with no expectation of near-term release. By highlighting strategic stockpiling, the narrative adds another layer to the argument that past pricing regimes are no longer relevant. Industrial demand consumes silver through use. Strategic accumulation removes it through storage. Together, they create a structural tightening that did not define earlier eras of the market. A further indication of silver's changing status is the decision by the United States to list silver as a strategic metal for the first time. This designation is presented as a formal acknowledgement that silver holds importance beyond its market price. It signals recognition at the policy level that access to silver carries national significance. The speaker treats this development as a marker rather than a catalyst. The designation does not create demand on its own, but it reflects an assessment that silver is essential to critical functions. By placing silver on a strategic list, the United States aligns its view of the metal with how other nations are already treating it. This shift carries implications for how silver is managed and prioritized. Strategic classification suggests that continuity of supply matters more than price stability. It elevates silver from a passive commodity to a resource that warrants protection and planning. The fact that this designation is new is central to the argument. For long periods, silver existed outside this framework, reinforcing assumptions of abundance. The change indicates that those assumptions are no longer consistent with current realities. By incorporating this policy acknowledgement, the narrative strengthens the case that silver's market behavior is responding to institutional reassessment. When governments redefine the role of a material, the downstream effects extend beyond short-term price action and into long-term structural demand. The expansion of silver's use cases is presented as another layer of irreversible change. The speaker notes that silver now has more than 10,000 applications, a breadth that reflects its integration into modern systems rather than niche functions. This wide range of uses increases the number of pathways through which silver is consumed and limits the likelihood of demand contraction. Particular attention is given to newer technologies where silver plays a critical role. Its growing importance in artificial intelligence infrastructure and solar energy is highlighted as evidence that demand is not static. These applications are described as additive rather than substitutive. They do not replace older uses of silver, but sit alongside them, expanding total consumption. What distinguishes these use cases is their forward-looking nature. Technologies like AI and solar are positioned as growth areas rather than mature industries. As adoption increases, the amount of silver required rises with it. This ties future silver demand to technological expansion rather than discretionary spending. The speaker emphasizes that these uses depend on silver's physical properties, which cannot be easily replicated at scale. This makes substitution difficult and reinforces the persistence of demand even as prices rise. Once incorporated into technological systems, silver becomes a necessary input rather than an optional one. By detailing the breadth and direction of silver's applications, This section reinforces the argument that earlier market conditions are unlikely to return. Demand is no longer narrow or cyclical. It is diversified, embedded, and expanding, reshaping how silver is absorbed by the global economy.